We're back, and it's time for Ask Annex. These guys were under a contract holdout. That's why they weren't here last week. So it's football season. You think they're stars or something. Is your agent now okay with you doing this show?
You know, I said for goodwill I'd keep it going while we work things out.
Okay, and Fred?
You know, I couldn't accept the franchise tag.
Fred Coleman is wealth manager in the CFP at Annex Wealth Management. Matt Morzy, director of research, also a CFP. Question 1 on Ask Annex. My online HYSA, high yield savings account, is dropping my rate 10 basis points, pointing to changing, quote, market condition. The Fed hasn't lowered interest rates yet. Doesn't seem right. Thank you. I had the same question last week. Now, what do you guys think?
You know, the Fed doesn't necessarily control what all of the market rates are. The market is going to change rates. In fact, as the Fed paused the federal funds rate after rising up quite a bit in 2022 into 2023, you know, the market adjusts accordingly. And as the Fed changed their messaging, as we get closer and closer to a cut here, which, you know, should be coming up very soon, the market has, you know, lowered rates itself, you know, of course, over that time period. So banks are going to move then, you know, as a reflection of what's happening in the market. But it's also important to remember that banks are going to set rates on a couple different variables. One of them is going to be their own profitability. So they're going to set rates that they're going to pay out you for the cash based on based on what they need to do to be profitable as a, you know, for public corporation, but also on client demand. If people are not upset that their rates are dropping and taking that money out, or demanding higher rates in order to have that money there, the bank's not incentivized to increase rates or keep it higher. You know, in fact, one really large financial institution never actually raised their rates at all during all of this. If you went online and looked at just their general savings account, still at 0.01%, they didn't have the demand in order to raise that rate on it. They have certainly higher level savings accounts that have different bells and whistles or potential fees that get put onto it, but their basic was still a 0.01. But if there's not that demand, or if they don't need that cash to come into the bank to fund everything else they're doing, there's not a reason for them to keep rates higher.
When do these things become JOSAs, which is just okay savings accounts?
I think we've got some time to go back to where we were before, but you know, rates will start coming down. Yields on savings accounts will go down along with it. Same with CDs and all those other things. But I think we've got some time before we get back to a spot where you can complain that you're not getting any interest anymore.
It's Ask Annex. Got a question for us. You head to the website, annexwealth.com. Look for the Ask tab. Question 2. Know-it-all neighbor says, I don't need to investigate long-term care until I'm 60. My understanding is prices rise as one ages.
There's a lot of factors when it comes to long-term care. The first thing I always tell people is to evaluate if you even need long-term care. There's a few things to look at. Look at your family history. Does your family have a history of needing long-term care? Also, how many assets do you have? If you don't have a lot of assets, usually it doesn't make sense to purchase long-term care. If you have an abundance of assets, then usually you can just self-fund without purchasing and paying those premiums every month. Also, I think your neighbor is right on the money as far as the age goes. If you buy long-term care before 55, you're probably going to be paying those premiums a little bit too long. And then if you wait too late, let's say 65, then it's a little too expensive. So your neighbor knows a little bit when it comes to that. But overall, I would say that there is a really small niche of people who actually need long-term care. So you want to make sure you do your due diligence before making the purchase.
Yeah, I think in finance, there's a lot of things that are rules of thumb, and the rules of thumb for a reason. But there are a lot of elements, you know, Social Security planning is another one too, where every single person is going to have something that's a little bit different for them, that makes sense for them, that might not make sense to their neighbor. You know, we hear that a lot. You know, my neighbor told me I should have taken Social Security already. Why am I not doing that? Or my neighbor's waiting until 70. Why am I not doing that? You know, I think it's different for everybody. Long-term care is even more specialized for the individual person. Age, you know, their asset level, like you mentioned, Fred, you know, family history, all those things combine to knowing who is the right person and at what point in time they should really be looking at that.
Okay, question 3 on Ask Annex. Sorry for the dumb question, but what makes an ETF a better sector choice than a nearly identical mutual fund version? Can you define ETF?
Yeah, ETF is exchange traded fund. Think of it as like a pooled set of investments like a mutual fund is, but it trades all day long like a stock does. So it's kind of a hybrid between the two. And yeah, in most situations, if you have a sector ETF and a sector mutual fund, keep in mind, from the exact same company that's managing both of them, they are probably identical to each other. Expense ratio is probably the same, but there are a couple of things that you'll want to think about in terms of, you know, choosing one or the other. One is flexibility, because an ETF does trade during the day like a stock does. If you want to be an active trader, Mutual fund, you can't do that
Do
with.
people do that?
Oh, certainly.
Really?
People try to day trade,
Okay.
not just individual stocks, but sectors as well too. But if you think you're going to want that flexibility to be able to do that, whether you're buying it for really short term, or you just want to know, hey, if the market's starting to go down and there's a day I might just want to get out, an ETF's a better choice because the mutual fund's only going to trade once a day at the close. And you have to make that decision generally before 2:30 in a lot of situations to be able to pull that trigger on the buy or sell side. The other thing you'll want to look at is potentially capital gains. Now, if it's a sector based, you're probably not going to have the potential for high capital gains in there. Most of them are pretty efficient from a mutual fund standpoint, but you still possibly could. So look at the mutual fund history. Have they paid out capital gain distributions? Because if they have, you don't have that control as a mutual fund investor. ETFs are much more tax efficient, so you have that ability to do that. But those are going to be a couple small things to look at, but ultimately, they're probably the same investment.
Matt Morzy, Director of Research, thank you.
Thank you.
Fred Coleman, Wealth Manager, CFP at Annex Wealth Management, thank you.
Thanks, Daddy.